Welcome to the first constitutional conversation of the school year. There are a few faces here that I don't recognize, so I'll introduce myself. Michael McConnell. I'm the director of the Constitutional Law Center here at Stanford, and we've put on, as you probably are aware, a series of speakers on various topics having something to do with the Constitution. Constitutional law broadly understood. Now you may be wondering, well, what does tonight's topic have to do with that? And I have to confess, I'll tell you why I chose this topic for tonight. I had thought that given the date, I planned this quite a long time ago, and I thought maybe we would have two candidates running for president talking about issues. And I thought maybe inequality would be one of them. I was rather wrong about that. I really should have invited an expert on groping, which seems to be what they want to talk about. But nonetheless, there is a connection between constitutionalism, and constitutional law in general, constitutional regimes, and the issue of income inequality. For example, in the 10th of the Federalist paper essays, probably the most famous of the Federalist essays, we see, and I'm just going to read you a very brief passage, the diversity and the faculties of men from which the rights of property originate is the source of differences of faction and interest in the nation. Goes on to say, the diversity, he says, the protection of these faculties is the first object of government. And from the protection of these different and unequal faculties of acquiring property, the possession of different degrees and kinds of property immediately results, and so forth. So the first object of government, according to the Federalist, is the protection of the unequal faculties of people, which lead to inequality of property. And then at the Constitutional Convention itself, we see various views on this. James Madison, often thought to be the principal figure, often called the father of the Constitution, worried that a too democratic legislature, one that's elected under too popular principles, would have a leveling spirit, and he refers to those. It will represent those who will labor under all the hardships of life and secretly sigh for a more equal distribution of its blessings. We need to guard against that. According to Madison. On the other hand, Gouverneur Morris, Alexander Hamilton's best friend at the convention and one of the most aristocratic figures in American politics of his day, predicted that the legislative branch would serve the interests of what he called the great and wealthy, and believed that we should guard against that through the construction of a powerful executive, of a powerful president. He said that the executive magistrate should be the guardian of the people, even of the lower classes, against legislative tyranny. So this issue of inequality was with us at the very beginning, and although there are few provisions of the Constitution that are directly addressed to that question of inequality, the structure of the Constitution was certainly designed with issues of equality and inequality and the protection of the rights of property and of the unequal faculties of acquiring it with that in mind. And so with that, let me introduce our speaker for this evening, longest justification for a topic you've ever heard, Professor Joe Bankman, of our own law school faculty here, the Ralph Parsons Professor of Law. He has been with us since, about 1980, graduate of Berkeley undergraduate, Yale Law School, one of the nation's foremost experts, not just on taxation in general, but on the effects of taxation on income distribution. So who could be better to talk to us on this subject? Joe?
Well, thank you for coming and showing interest in this topic. See, to me, who wouldn't be interested in this topic? Who would need an excuse to talk about tax and income distribution? So I'm honored that you all came here. We'll see the Constitution pop up here and there in my topic, and largely in the ways Michael says, as maybe a protection against a certain kind of redistributional impulse. But I think it's safe to say that in any society, if you read the Bible, if you look at ancient Rome, if you go to Greece and so on, people are always interested in who gets what. And tax has always been a way to affect who gets what when the music stops. So it's been of interest to a lot of people for a long time. I got the topic from Michael. It's a topic I am interested in, I like a lot, but I want to outline my role here. That's something an architect would use, because a tax scholar and a kind of a tax policy wonk, in a way we're like an architect. We hear what people want, and we tell them how much it would cost to build. We say, here's the kind of house you could have, and here are some pluses and minuses of it. So when I get a topic like inequality, I go to, well, I know there's controversies over inequality. I'm going to give you some background and talk about some pluses and minuses to changing inequality through taxes. And my goal is to spend only about 20 minutes on the talk, and even have a little audience participation, and then to answer questions you might have. Right? But first I'm going to give some data to you. Of course, like architects everywhere, we might have our own favorite kind of home that we like, style. But I really see my role here just to talk about what kind of buildings we could have using the tax code to change inequality. So let's see. This is a clicker. This is supposed to work. Okay. You might hear a lot that the rich are getting richer, and that seems to be true by any stats you look at. I'm using Congressional Budget Office stats, but they all say about the same thing. If you go back 35 years and take people in the bottom quintile, that's the bottom 20%, and look at how their income has changed in real terms, it's increased by about 20%. That's not nothing, you know. We've gone through periods, hundreds of years, where income levels haven't increased at all. But it's less than the increase in the previous 35 years, and it's less than the increase the top 20% has enjoyed, which is some multiple of that, something like about almost 10 times higher. So the rich have gotten richer by conventional definitions. Lots of theories for it. The most likely reason is globalization, which is increase the rewards for the best. If you were the best in a regional economy, you got rewarded pretty well. But there's lots of people in regions. Now it's the best in a global economy that gets rewarded very well. So the rewards at the top seem to increase. But that's not really my talk, because the answer is tax policy scholars don't have great theories on why the wealthy have gotten wealthier as a function of globalization. When we measure income distribution, sometimes we look at the top 5% or the top 1%. There's a stat we use, named after an Italian economist named Gini, so we call it the Gini coefficient. And here's how this stat works. If everybody has the same income in society, the Gini coefficient is 0. That's complete equality. If, say, Michael over there owns everything in society, all the income goes to Michael, the Gini coefficient would be 1. So it's just a way of describing the income distribution of a society. And if you look it up on Wikipedia and you got a mind for those things, it'd take you about 1 minute to get a real understanding of it, but I'm not going to give them a minute. All I'm going to say is the Gini coefficient shows what most people are experiencing, that our society has become less equal. The Gini coefficient is higher than it was. Remember, once we get to 1, Michael owns all the property and the income. By the way, these are Gini coefficients on income. We have some of wealth, and the wealth is a little bit more extreme. So, of course, by the way, everything I've shown you is market income. I haven't dealt with the government yet. But, of course, the government's always doing things, right? It's taking money and it's giving services. So when we look at how the poor, the wealthy are doing, a more meaningful figure, I think, is after the government has done its number, right? It's taxed everybody, or taxed a lot of people, and it's transferred some of that wealth. So if we look at the government transfers, we're all familiar with the federal income tax. That's highly progressive. The wealthy pay more, not just in absolute terms, but as a percentage. So on the federal income tax, for example, the bottom 20%, the bottom quintile, don't pay anything. In fact, they get money back through the earned income tax credit. So the net pay-ins on the bottom quintile is 0. The bottom 50% pay a few percent of the federal income tax, less than 5%. The top 5% pay over half of the federal income tax. So the federal income tax is paid predominantly by high-income individuals. Other federal taxes are less progressive, payroll tax in particular. Other taxes that we might be thinking about is a corporate income tax, and economists have ways of guessing who is ending up paying that, and state and gift tax, and some small taxes like gas taxes. Of course, the federal government not only taxes people, it gives services. Economists and tax policy types don't try to allocate the benefit from, say, defense, or actually schools in general, or roads, but they do allocate some transfers that seem pretty clearly designed, mostly to help the poor. Medical transfers are about $1 trillion a year between Medicare, Medicaid, and subsidies under the Affordable Care Act. Those are very progressive in practice, and so people estimate who benefits from them. Social Security, another very progressive system. And there's another $100 billion thrown out here and there in things like food stamps and especially earmarked educational expenditures and the like. So what happens after the federal government does its number? The lowest quintile gets a little bit more income after the tax transfer system. Instead of having 5% of the income, they have 6%. The highest quintile has a little bit less. Instead of having 37.6, it goes down to 36.1. The top 10% suffers the biggest decrement. Instead of having 15% of the income after we do, the government gets involved, it has a 12.5%. And the Gini coefficient, of course, declines. Things are a little bit more equal. Now, that's a lot of figures just to throw at you. Let me ask you something. Now that you see this, what I want to ask you, this is audience participation. I'm going to ask you, is this more or less than you would have thought? So let's look, let me make this more specific. Let's look at the lowest quintile. It goes up from 5% of the income in value to 6, a little over 6 after the transfers come in. How many people think that's a greater amount of transfer than they thought? How many think that I didn't think it was so big? How about the opposite? A couple. How many think that's less than I would have thought? Yeah. I think most people are surprised like this. I've been working with these figures so long, I'm no longer surprised. And of course, there's lots of ways to describe things, but I think in general, one of the things that surprises people about tax is actually it has a little less effect than most people think. We have this great engine of the market that's producing income here and there, and even when we think we're doing a lot in tax, it often turns out that we're doing a little less than we think. Okay, so we do affect the distribution of wealth through transfers. But some people think maybe we should do more. And of course, what would be the right place to go back to? Well, one of the right places to some people is where we were, because in the last 30 years, tax rates have fallen. Now, I should say, notwithstanding the fact that tax rates have fallen, in the last 30 years, the wealthy have paid a bigger share of the total tax. Both can be true because the wealthy have gotten wealthier. So, but tax rates have fallen from 50% to roughly 40%. From capital gain, about the same kind of fall, maybe even a greater one. These are federal rates, and of course, those of you who study this know that these are simplifications. There's other taxes I'm not including. If you live in California, which is a high-tax state, you have another over 10% of tax you're paying. But one proposal is, what if we went back to where we were? What would that do? So I'm going to talk about that for about 5 minutes or so. One thing we want to know is, if we went back to where we were and we raised the rates, how much would it cost? What happens when you tax people, right? Oh, excuse me. This is, look at who popped up here. I actually forgot that I put this little interlude here, but it's an important point. Anybody know who this guy is? There you go. There you go. It's Larry Ellison, and he's one of the wealthiest people around. And what he is famous for doing is not selling his Oracle stock, but he supports himself by borrowing against the appreciated stock. And a couple of years ago, Oracle reported that he pledged $10 billion of his stock to banks as collateral so he could fund $10 billion of investments or consumption. The reason I put him up there is he doesn't have income with that borrowing. So when we talk about income, and I'm basing everything on income, we have to understand it's an imperfect measure. Maybe what we really want to look at is wealth or consumption, right? Or maybe we're not so interested in ex post consequences. We want to make sure everybody has an equal start. So we want to look at measures of opportunity. We can pick this up later, but I want to cabin everything I'm saying that it's ignoring these really legitimate critiques at conventional analysis. And I'll try to weave them in maybe toward the end. Okay, so suppose we want to redistribute income, because that's what we're working with. How much does it cost? That is, what is the efficiency cost of taxing the wealthy? And of course, there are a million ways to look at it, and economists vary. And what I tried to do here is to find a kind of a centrist estimate to give you a sense of the range. And what I did is I took two great economists, Emmanuel Sayers at Cal and Joe Slinrod at Michigan. And I tried to kind of mix a little bit of that in terms of orientation. Sayers in particular is very progressive. He's co-authored many works with Tomas Piketty. So then you would think, well, maybe he's going to understate the cost of redistribution. But in this study, he's using a methodology, Martin Feldstein, which is kind of conservative and is often thought to overstate costs. So I just tried to do the best I can to give you a middle of the road figure. And here's what Emmanuel and Joel say. They say for every dollar we redistribute, we lose 35 cents. So that's the kind of welfare loss. How do you lose it? It's because people turn down a job they otherwise would have taken. They decide not to save when they would have saved. Or a big cause of that is they hire people like my great students and graduates, like Sean here, who's now an alum. If you hire Sean, you can save your tax bill. But of course, that's also a cost for society, right? And so they've got a methodology that comes up to 35 cents on the dollar. Actually, though, if I really want to give you the right number, we probably have to increase it. They were working on a small increase when the tax rates were low. The tax rates are higher now, so the cost would be higher to redistribute. They used elasticity behavioral response estimates that were lower than some people had. Some people that they report estimated the cost of over 60 cents. And finally, we've got to consider some costs on the government side of compliance. This does include, by the way, the taxpayer compliance costs in a way. So we're talking about maybe 40, 50 cents lost for every dollar we want to tax at the margin. Okay, here's another audience participation thing, right? Suppose we take it costs 50 cents, and I guess we sometimes call that dead weight loss, social cost waste, to redistribute a dollar. I'm going to ask you, is that more or less than you would have thought? Let's assume these guys are right. How many people think that's more expensive than they would have thought? More expensive. Okay, how many less? That's really interesting. Thank you. This is useful for me because, again, I've lived with these numbers so long that they don't surprise me at all. Some people think on the margin in certain taxes, the marginal cost of distributing a dollar is at least $1. And that's a high estimate, but that doesn't raise a lot of eyebrows that could happen. Certainly with some taxes it would. Taxes on labor that are the subject of this estimate are actually easiest taxes to get. Okay. I just want to give you a sense of other estimates to tell you the range. If you wanted to say that the costs are low, what you do is you look at time series data and you say things like when tax rates were very high, we were very prosperous as a country, and we had a lot of growth. And that evidence is a little bit inconsistent with our best guesses now, looking at cross-sectional data and using other approaches. But the estimate's out there. There's an optimal tax literature I'm going to pick up later on. So suppose we said that's okay. We're willing to spend $0.50 to redistribute $1. We're taxing it from people that are making a lot, so we're thinking 500,000 and up would basically be top 1%ers. So we might be thinking we're taxing the top 2 or 3% and we're redistributing it. And suppose we tax the top 2 or 3% and add it, raise the top brackets back to 50%, and gave the money to people in the lowest quintile. That's the experiment. And this was a paper by Bill Gale, who's at the Brookings Institution, along with Peter Orszag and Carney. I'm embarrassed to say I don't know Carney's first name. But whoever she is, I'm sure she's terrific. And here's what they found. They found it didn't do as much as they thought. And again, that's maybe a little consistent with my introduction to you, right? I mean, we have this huge tax apparatus, right? And how much does it affect the share of wealth that the bottom 20% get? Really not that much compared to the market outcomes. Here, the Gini coefficient fell only 1 point, even with what we might think of as pretty serious redistribution here. So what's going on? Well, here's one thing that's going on, is that this is taxing ordinary income and non-capital. This is what happens if we tax high wage earners. How about if we tax capital? Now, capital, to be sure, is actually, as it's conventionally mentioned, a relatively small part of what we tax. Most of the government runs off of wages. Even in people in the upper 10%, almost all of their income is wage income. If you go to the bottom 50%, there's almost no capital income. But when you get to the top 1%, capital income becomes about 1/3 of what people have. And when you get to the very top, it's most of what people have. So if you look at like the Fortune 400, most of that income is capital income, and it's taxed at capital gain rates. And we see the overall effective tax rate actually falls as we get to the very top of the income distribution. So why not tax the hell out of that? Have we solved our problem? The problem is capital is tougher to tax. One of the reasons is people work for social reasons, And what we found is we can really ratchet up the tax rate. It's really high and people keep working. You don't have the kind of social normative reasons working for you so much on your savings. You don't have to save because if you don't save, people are going to look askance at you. Capital is more sensitive to tax because we can't count on people having to work a 40-hour week. We have to worry about capital fleeing the jurisdiction. And finally, we make capital taxation easy to avoid. How do we do that? We have a tax system that says if you keep your capital until you die, your kids can sell it tax-free. Well, on the margin, if we start to tax it too much, what are people going to do? They'll say, okay, I'll just keep it, right? We don't tax people until they sell their capital. So what are people going to do? You want to tax it a lot, I just won't sell it. We allow people to borrow off their capital to fund consumption. So we start taxing it. Everybody's going to start doing what Larry Ellison does. And we allow deferral on foreign source income. Once we have all of these things working against us, taxing capital becomes very difficult. The maximum rate that we can tax capital is always going to be lower than labor. There's a couple of other problems of taxing capital, and these are kind of normative problems. And I know Michael's heard me say this, but I'll bore the rest of you briefly with this tale of a guy named Irving Fisher. Does anybody know Irving? How many people have heard of Irving Fisher? A few people. Turn of the last century economist, a brilliant guy. And he has this tale of brothers. There's 3 in his tale, but only 2 in the one I give you. They each inherit the same amount. Right? One saves his inheritance and one spends it. And Fisher points out that in the no-tax world, there'd be no tax difference between the two. But in the tax world, the guy who saves his inheritance to spend it later is going to pay more tax. But Fisher asks, what knowledge do we have that the saver is better off than the spender? They both had the same opportunity, right? Why do we think that the saver is wealthier than the spender? I sometimes give a variant of this for people, and it's a thought experiment for all of you. Imagine that you're 19. For some of us, that's going to be a little tougher. And you've got a few $1,000, and you could go to Europe. But if you go to Europe, you're going to be backpacking around and live in a kind of hostel. But that's going to be your experience. Or you could save that money and at plausible rates of return. When you're about 30, you could go to Europe and stay in kind of a nicer hotel. Or you could save it even more, and when you're my age, $1 million or so, you could go to Europe and stay in a really nice hotel. And so the thought experiment is if there's 3 people like you, who's wealthier? Like, who optimized? I think when you think of I don't know, the person that did it early got their enjoyment early, got a lot of memories. The person that does it later has something to look forward to and, slept on a better mattress maybe, ate, drank better wine. I don't know who's wealthier. But that's implicated in how we tax savings. There's also something called the life cycle hypothesis. My guess is if you've heard of Irving Fisher, you've heard of that. So we have at least one person who knows that, which points out that young people are borrowers, middle-aged people save, and older people spend. So that to some extent, when we tax savers, we're taxing the middle-aged version to redistribute to the younger version of ourselves. These, of course, are just huge abstractions. But where does that leave us? If we want to tax savings to meaningfully address inequality, what could we do? Right? First of all, we have to start at the top and change our treatment of entrepreneurial income. It doesn't make sense to worry about inequality and allow the wealthiest people to pay tax at the lowest rate. So if that's what you care about, is ex post inequality, you'd want to change the treatment of people like Larry Ellison. But it'd be a pretty major change. You might say when your company goes public, the government gets a share of the stock that's really, you might say, your founder's stock, that's really salary income, not capital income, and the government could hold it in a non-voting trust and sell it off over a number of years. You would have to eliminate the escape hatch of just being able to borrow out appreciation. We could do that. You'd have to eliminate the step up in death. You'd have to eliminate the deferral on foreign source income. If you did that, we could start redistributing the income from capital as well. How about other solutions? Well, we could just go to a wealth tax. I said sooner or later we're going to get to the Constitution. Thomas Piketty, he wrote a big book. How many people have tried to read the book or read the book? Look at you! And did you finish it?
Tried to read the book.
What's that?
Tried to.
I wrote a very long review of it, so I actually had to read the book. And I finished the whole damn thing, but it's about 1 million pages. But what he says, and we can talk about this more, is we ought to have a wealth tax. And in fact, a wealth tax would be a more efficient way of taxing capital than an income tax. I mean, if we're bothered by people of great wealth, we can tax it directly. We indirectly, of course, are reducing the income from the wealth, or at least the consumption of the wealth. And the only problem with doing it is that darn Constitution, because the framers put in a clause that prohibits direct taxes. And, they never really said exactly what a direct tax is, but we know what they were thinking of as property taxes. The state could do that and the federal government couldn't. They wanted to reserve that for the states. Well, a tax on wealth is a property tax. And under most conventional readings of the Constitution, it just wouldn't fly. So we can't have a direct wealth tax. We could try to sneak in something like a wealth tax, have an imputed return on property, and tax that. Sweden does that. I suppose we could do something like that. We could have a consumption tax. Most people that are kind of economistically inclined think it's more efficient to tax consumption than income. For one thing, a consumption tax doesn't discourage savings or capital formation, so there's some nice features of that. If you think about a consumption tax, there's really two ways to go. The one that we know the most is a European-type VAT. The tax itself is not progressive, but you could take the money and redistribute it. And to some extent, that's what Western Europe does. They've got a big kind of welfare state with lots of government services, and they fund it through a VAT. I want to give time to answer questions. I'm mindful that I'm almost up to my half hour. So I want to end on another question, which is how do academics think of this whole question about what the just tax rate is? So far, all I gave you is facts, right? Here's how much it would cost. How do you think of what's the right thing to do? And I just want to outline 3 approaches briefly. If you're a libertarian, Robert Nozick's your guy. How many have read Nozick in here? Wow, okay. So Nozick says basically you ought to get what you pay for from the government. The government exists really just to protect you. You entered into this compact, but it has no moral claim on the fruits of your labor. So, on the other side of the political spectrum, you could have someone like John Rawls. How many have read John Rawls here? More? Okay. Rawls imagines bargaining behind a veil of ignorance where people agree to a very redistributionist state. I think that's all I'll say. The optimal tax literature is how kind of econo-heads look at it. Anybody familiar with that? Okay, here's what economists do, and fellow travelers. They say, well, just give us a function, a formula to maximize. And the formula tends to be kind of utilitarianism. And so they say, well, gee, we think there's a declining marginal utility of money. So that by itself would just lead us to equalize all incomes, or all wealth. But we know if we do it, we're going to have bad incentive effects. We'll have a very small pie to distribute. So we'll keep redistributing wealth and seeing what that does to utility, but we'll also be mindful of the size of the pie. So it's through a glass darkly, a little bit garbage in, garbage out, but for whatever it's worth, one kind of persistent result it gives is kind of relatively flat marginal rates with a lot of redistribution. Okay. Why don't how should we do questions here? Because I want to give time to answer people and to talk to you all instead of lecture.
Well, since it's such a big room, rather than passing the microphone around, if people would just come down and line up at the two microphones, that would be easier. But first, I think we ought to give Joe a round of applause.
Somewhat confused. Tax, flat, and redistribute. It seems to me that that's like a progressive tax. So how is that? I mean, basically, if I'm poor, I don't get taxed much. If I'm rich, I get taxed a lot.
Yeah.
What's the difference between doing that and doing that?
Well, it's a great question. When we use the term of flat and progressive on taxes, a progressive tax has higher rates as income increases. A flat tax has the same rate with income increasing. Now, the same rate means that the wealthy are going to pay more. So what your question brings out is you could have a quote-unquote flat tax that's quite redistributionist because you're going to be paying more than someone with no income or low income. So flat taxes do redistribute income.
No, I was comparing the flat with a redistribution, which is what you said was the optimal tax literature, right?
Yes.
Now compare that with no redistribution or much less and a more progressive tax. Doesn't the rich get the same amount in take-home pay after taxes and redistribution, and the poor get the same amount? So what?
Okay, so the question is, it depends what we want to compare. One of the results, and these are just model results, I really just give it to you to give you an idea of what simulations produce. If you have different ethical perspectives, you might not like that. There's no reason that most of you are utilitarian. In fact, my guess is very few of you are. Very few people are in general. Having said that, the comparison you want me to make, and I'm willing to do it, is we could have a very steeply progressive tax and no redistribution, but we just pay for government. Of course, government is always going to have some redistribution in it, but we would have less. Or we could have a flat tax, like Western Europe does, and a lot of government programs that are redistributive. And then if we compare the two systems, it really depends on how high is up. When you say no redistribution, it really depends on what you're considering in that world as redistribution. And when we say a flat tax with redistribution, the devil's in the details. It depends how much we have.
You commented earlier on the marginal cost of redistribution.
Yeah.
And I wish you'd elaborate a little bit further. I think some of the figures were in the range of 35 to 50%. It would seem pretty obvious that the cost of redistribution is dependent upon what level of taxation is going on. People are going to do a lot more to avoid taxes when the taxes are high and less when they're low.
Yeah.
So could you comment further on the
Great
assumptions?
question, and you're absolutely right. Yeah, just to pick up on that point, it's kind of a neat point. If the tax is 0 and I impose a 1% tax, the costs are going to be pretty small because if you're giving up a work opportunity, you must have not really cared very much about that in the first place, right? So the costs are going to rise as the rates rise. What this exercise was is it was thinking of expanding the highest marginal rates. So this was in 2012. So it was a cost of raising the rates from the then 35% to, say, 40%. So that was, in that case, it was a cost from going 35 to 40. Now we're already at 40, so we'd have to look at going from 40 to 45, and the cost would be higher. Yeah.
It's said that the object of the game is not to be rich, but to live like you're rich. So we have the Larry Ellison and others. We have some exemplary examples, the Zuckerbergs promising to give most of their wealth to. Trump has challenged Clinton, why didn't you already fix this? Let's say there's a reasonable chance that Clinton ends up as president, and we might end up with a Democratic Congress. What are the changes that could make sense that would keep the Wall Street traders and others that are not doing good with their money, they're just accumulating it and sending it offshore? How could they be forced to contribute to free college education or something, as Clinton has proposed? I don't quite understand what changes would have to be made to make that work.
Well, it's really a variant of how we could raise more money from the wealthy right now. So if what you think is the wealthier, they ought to pay more, then you'd want to do these things. Now, what will really happen, of course, is just a different kind of question entirely. As somebody who has kind of worked with legislatures and testified, I don't think I'd hold my breath for an ideal tax system. I'm guessing, actually, the Wall Street traders, whatever you think of them, they actually pay a lot more tax than Silicon Valley types because they get their income as ordinary income, as it turns out. So that's one group that is probably relatively easy to tax. And in fact, if you look at the people the billionaires who are paying tax now, the hedge fund guys actually pay a lot of tax on the whole. I know, I see the look of, like, how could that be? But it just turns out to be true. It's not that they want to, it's just that a lot of them can't find a way to shelter that income because it's publicly known and it comes in a form that isn't as good as the income of, say, a venture capitalist. So, but we could do all of these things. We'd raise the rates on ordinary income. We'd raise the rates on capital gain. We'd stop some escape hatches. And that would raise, $100 billion, which is a lot of money, even though it's not going to transform society. That's what I would guess would be a likely outcome if the Democrats, hypothetically, the Democrats control all three branches of government. Yeah.
I think
you can yell.
Yeah, I think I can yell. So I want to switch the focus from taxes to inequality.
Yeah.
And I think building on the last question and the presidential debate, the support for Trump appears to be based on, to a great extent, on the sense of inequality.
Yeah.
That there is a segment of society that has not benefited as much as other segments.
Yeah.
And so the question that I have is, what, if any, is the relationship positions, one tax to more rich versus a lower flat tax for everyone who corporate tax, that gives the sense that that would essentially lead to a reduction in inequality?
Well, it's a great question. Of course, in one sense, just depending how you measure it, if you use something like the Gini coefficient, you take enough income and wealth from the rich. Even if you don't benefit the poor, you reduce inequality because it's just the difference, right? But if what you're saying, if what we're doing is we're looking at this bottom quintile, whose wages have been pretty stagnant, right? And it's lousy to be in the stagnant bottom quartile, we can give them some redistribution, but of course what you'd really like is market opportunities that are going to raise you up. That's just, I'm guessing. I'm not in that quintile, obviously, quite frankly. But my read of it is that what you'd really like is to think that your kid was going to get a great job, and that's really what you're not seeing, and that's just true. And I don't think anything we do on taxes is necessarily going to get the job. Obviously, there's other approaches, education and the like, but it's easy to hype the education solution for unskilled labor in this country, but the experiments in education haven't been that successful either. So I think it's a really hard question, getting good market outcomes for this this bottom fifth of the country. Yeah.
Two questions. One is government spending tax constrained? One, and then two, what about the debt figure?
It's a great question. It's certainly not tax constrained because we spend so much more than we raise, and we have this enormous overhanging debt, and which is higher than it's ever been, about 80% of our GDP. And the huge unrealistic dream is not to reduce it, but to prevent it from growing more and more as we start having to pay out more and more for the baby boomers, people like me.
I follow that up for a second.
Yes.
So, and that tax, the debt, actually, is that a form of redistribution to the upper income?
Well, it's a generational redistribution. So what we've done is we're spending basically our kids' money, because sooner or later, some of you are young enough, I've been spending your money because my tax rates have fallen, but I haven't been paying for the government and paying for the accrued liabilities. So the next generation is going to have to, and one of the backgrounds in all of this is taxes are we've actually had tax increases that are disguised in the form of debt, but our kids are going to have to pay off that debt, and they're going to have to tax themselves quite highly to pay off the debt. So that's something like adding another, whatever your tax rate is, if we added 3 points to it, say from 39 to 42, that's the range we'd have to do from now forever to deal with this. Every year we don't do it, of course, we're going to have to raise it more. Yeah.
If somehow the total debt suddenly appeared from heaven or someplace, who would be the beneficial recipients of that debt? Which persons would receive it?
If debt, I'm not sure.
We owe money.
It's like, say we have $20 trillion debt. Suddenly, if it just somehow...
Oh, I got it. Who's been lending the money, right? Who's been lending the money?
No, who will receive the money? That should be the same people who has loaned it, but which actual persons are going to receive this trillions of dollars?
Well, a lot of it has been foreign money invested.
No, it isn't.
Chinese money, but it's not all of it. Anybody that owns bonds has been funding the government. So if you have saving bonds, treasury bonds, you've been funding the government, and you're a creditor, and a lot of pension plans and the like are creditors as well. Yeah.
Is there also an incentive effect from redistribution efforts in addition to taxation efforts, or is that largely kind of a bump?
Yeah, sure. So that when you give someone money, when we say incentive, it's just behavioral effects. So actually, your thought experiments are kind of useful here. What happens if you give money, and how does that affect, what you do? What we found, though, is it's actually very complicated because when you give some people that are very poor money, it actually gives them enough money to kind of have a better chance of getting a job. It might be you can fix your car and then take a job. We find this play itself out most interestingly with the Earned Income Tax Credit, which pays you for your first dollar of work, but then starts reducing the credit, in effect adding a tax to you after you work. So what we find is that transfer payments on the whole make you a little wealthier and discourage work a little bit. There's an income or wealth effect to that. Probably not huge, but and a kind of a complicated answer I'm not going to give you, but maybe that's a partial answer. Yeah.
Do you think rent-seeking effects are as high as, like, say, S&P, say they are?
Yeah.
And if not, can you recommend any papers or resources?
I'm just not convinced of that. Like, and I say I'm a little bit split because, it's a small world, and I think he's fantastic and a lot. But he has this paper and this is in Piketty's book. And Piketty says that when we lowered the tax, he has a story. Here's his story. We lower the tax, and then corporate CEOs say, now that the tax is lower, I have more incentive to basically steal money from shareholders by upping my compensation. And that's a kind of rent-seeking that Sayers and Piketty finds. Piketty finds this throughout history, that there's a lot of rent-seeking, and in Piketty and Sayers' mind, we don't get anything for that. We're not getting any greater work effort on these CEOs. I think this story, the narrative doesn't really work because it's very first of all, if we look at the best paid folks in society, you can't really say they're rent seeking. Basically, they're hedge fund guys who other wealthy people are hiring to invest their money. So it's not like, they're knowledgeable investors, billionaires that are giving them money. So it's hard to see that as rent seeking. If we look at other occupations, we kind of see globalization has really made this winner-take-all group for lawyers, for the best paid in any profession, musicians even, right? So I think the rent-seeking is at best a very small piece of the puzzle. And I actually wrote something on Piketty, a long review, and it appeared in a journal I know you all read, the Tax Law Review. But you put in Bankman, the Tax Law Review, and you'll find a footnote on your question. Yeah.
Are there any tax policies that would have a leveling effect on opportunity as opposed to wealth, like we were alluding to in previous answer?
I don't know. I mean, because what you'd like to do is to get greater opportunity at the bottom of the income bracket. And what we do find is that there's less intergenerational mobility in this country than our peer countries generally. So we think of this as the rags to riches country, but actually it's less so than most other countries that we would compare themselves to. And so if you look at, say, Ross Chetty's work, and you just go on the website and type his name, he's an economist there, he has this really interesting chart that says, how likely is it that you'll be in, say, the top quintile, having started in the bottom quintile, right? And how does that compare to other countries? It's really less likely here. So then the question is, what could we do to increase it? We do all sorts of things in the tax law to kind of encourage education, but actually have the exact opposite effect in a way, because the people that are going to take advantage of them are on the whole the wealthier people, right? Because that's who's going to college. So free college education, which sounds like that could do it, actually could be a boon to the wealthy because they're the ones going to college. So it's very tricky. I think that in general, the tax law isn't going to be the way to deal with opportunity. We've got to get kind of better schools and put more money into that. And that's going off my expertise a little bit, but I do study that somewhat, and that's my own thought. Yeah. You can just yell.
I was wondering, of the 39% of sort of waste in the tax collection system, what is that comprised of, and are there kind of, somewhat simple ways to try to reduce that?
Well, it's comprised of, I think you can think of three, I think of it as in two categories. One is real behavioral change, where I would have taken that job if I got all the pay from it, but the government's going to horn in and take a third of that. I'd rather have the leisure time. So that's one big source. And the same thing is true on savings. On the whole, I'd be willing to save money, but if the government's taking a third of that, I don't mind spending it either. So it's spending instead of saving and loafing instead of working. But the other third is hiring lawyers, right? And that's the general. It's also cheating and doing things to evade. We could make it harder to avoid and have like a cleaner tax system. That probably limit it a little bit. Yeah.
Follow-up to
that's not really money that could come back. At least the first two categories sound like people would only, they wouldn't be generating more tax revenue. They're making a decision to not work because of the fact that they would have to pay tax.
Yeah, that's right. But that's what we consider when we consider waste. That's a good point. I want to make it clear that that is a lot of the 35%. And you're quite right. It's welfare that people would have had if the tax law had been there. But with the tax law, it just doesn't exist. So it's not like we're taking the dollar and we're taking 30 cents and we're throwing it in a hole. This is 30 cents of welfare that would have been created that isn't. So we never get it. Yes. I'm just looking so everybody gets it. Yes. Okay.
Okay. So in Mendocino and other pot growing counties, the economy is a off-book cash tax economy, but it fuels the county. It pays the taxes, the local taxes. The guys go and they buy trucks and farm equipment and everything. So what's going to happen when pot gets legalized and the corporate giant pot farms take over, and when everybody has to declare the income? What's it going to do to the economy of those counties?
Well, right now we have this big subsidy. We have an untaxed sector, and it's cash business, especially cash business that's illegal, right? And so we don't tax it, and of course it's bigger than it would be. And if we started to tax it, guess what? It would get smaller. So in this case, it's going to get smaller for two reasons. Probably I agree that in the end, a RAND study said that in order to grow enough pot for the whole country, one big Iowa farm could do it. So we don't need a lot of independent artisans out there probably, and probably we'll get that big farm if we allow that. So you're going to have a lot of unemployment in Mendocino. On the other hand, our tax coffers are going to increase a little bit, and we've seen that in Colorado, for example, because the untaxed money becomes taxed, and when you can buy your pot at Safeway with your liquor, we'll give you even more, I suppose. Yeah.
I don't think you used the word fair yet this evening. And is there any reasonable literature that that makes a halfway successful attempt at describing what
a fair tax would be?
Not the fair tax.
No, I understand. What would be fair? I think that the bottom two sources are sources that give you a definition of fairness. Each one is contestable because when you read it, for example, you read Nozick's view that you should get what you pay for. It immediately raises the question, how are we going to measure what the benefit is and who benefits from? But there's a really interesting literature on the fairness. I might also recommend a colleague and partner of mine, Barbara Freed, who writes on the same subject. And if you just, Google Freed and, Nozick or Rawls, you'll get that. I didn't mention it because it tends to not get you as far as you might think because our notion of what is fair turns out to be a combination of underlying philosophical starting places and empirical assumptions. And once we get this many in the room, nothing would hit you on each other's throats faster than that. So that's why I did it. Yeah.
How efficient are state taxes and where do they
it's basically the same thing, a little less efficient because you can always move out of state, so there's a natural state tax. The good news is actually people don't move out of state that much. We're testing it a little bit.
State tax.
Pardon?
No state tax.
Oh, I thought you said STATE, like California state.
No.
Oh, you said estate taxes. Oh, thank you. Okay. Estate taxes are generally, there's two ways to look at them. Here's the way. If you think that people save just because they have nothing else to do with the money, and when they're dead they don't care, then estate taxes are really efficient because we're not going to discourage anybody from doing anything because the savers will, by definition, you'll know you can spend it as long as you live. Under most other assumptions, they're inefficient. So if you wanted a progressive tax and you wanted to redistribute things, and you didn't particularly care about dynasties or something, you didn't have a special worry about them, you probably don't have estate taxes, because it's inefficient generally to levy all the tax at one time, and it's generally inefficient to discourage people from saving. So they're on the inefficient side of taxes, most commonly considered. They're not a big revenue source, though. They're symbolically important, maybe, but we've actually never gotten very much money from the state taxes. Yeah?
Two questions. Why don't we, instead of taxing the lower income bracket and then try to give it back, and have the inefficiency, just tax the below a certain income zero? And then second of all, do people like Buffett and Trump, who are audited every year, they end up costing us money because if they don't pay tax, or we're spending all that bureaucracy auditing them, then don't they end up costing us money?
Well, here's the good news. We always get some money when we audit them. Like it or not, they rarely go away without paying. And if we didn't audit them, of course, we'd worry then we'd get much less than. So the cost of audit's pretty small. The average here's a factoid for you. Suppose we double the audit size of the IRS. Now that's not going to make you very popular, right? But each auditor pays 64 times their salary in both the deterrent effect and the specific amount they get. So auditing is really efficient, but I guess it's like giving the highway patrol radar, right? We're a little bit ambivalent about it. Yeah.
Isn't the rationale for the capital gains tax being lower than ordinary income tax that it actually then, the trickle down benefits the economy, which then helps that lower margin? So is there an empirical basis to that?
Well, I think the best, it's hard to know what the rationale is because people say so many different things. I think the best rationale for it is the one I gave, that if we tax it at the same rate, we probably even get less money than we do now because it's too easy to avoid. So we've got a problem taxing capital at a high rate because it's more responsive to taxation. But another side of it is it does discourage capital formation. So in the long run, taxing capital formation at a high rate is probably bad. Most people that care about redistribution, if they could press a button, would have that are kind of tax policy wonks, would have something like a very progressive consumption tax, where we would tax people when they spend money, not when they earn them. But if they spend a lot, we might tax the heck out of them. But that would be not a tax on capital. I know that there's so much embedded in that answer, and I kind of apologize. That's the best I can do in 2 sentences, yeah.
So to go one level lower on that answer,
Yeah.
and follow on to the question, why is tax on capital so easy to avoid?
Because I think it's for some of the reasons I put up there. Let's see if I can find it. It's more sensitive because people work. If you tax the hell out of someone, you kind of have to work in this society. And so you can tax people at 70%, and labor doesn't decrease very much. If we tax people on capital, we find it's just empirically more sensitive, and we've also made it easier to avoid by having specific rules in our capital tax.
That law has been passed to make it easy to avoid.
Yes.
All right, so I guess
that's part of it.
That was behind my question.
Yeah. Okay.
Is it the law that makes it easy to avoid?
Yeah.
Or is it deviousness?
Well, everybody's going to be devious when it comes to paying taxes. I got to tell you that if you want to understand taxpayers, you got to think most people, if they can save money, they're going to do it. So we've got to have a law that doesn't allow it if we want to get taxed. So we'd have to at least do this. Even if we did this, we had the best law possible. the optimal rate on capital is likely to be less than savings, I think. And that's just because people are more likely to not save than not work. Except capital and labor effort. Thank you. Yeah.
I wanted to ask you also, building off of all this, to elaborate about the reasons for a consumption tax being more efficient, since it's kind of come up a little bit. In the
Yeah, I know, and I keep saying it, and then I never explain it. Well, here's the good news. I wrote an interminable article on this, and if you look up Bankman and consumption tax, you'll read it. It really has to do with taxing. If people work in order to save, and then spend in the long run, it turns out to be more efficient to tax them at the front end on their labor effort, and then let them decide whether to save or not. And a consumption tax kind of gets you that. So it just tends to be taxing deferred consumption more than current consumption. It's a little bit like taxing apples more than oranges. It's going to distort people's decision of whether to have an apple or an orange. And there's another way to raise the same amount of revenue that doesn't distort that decision. So even if you want to tax the wealthy and you think the wealthy is where the capital is, you're adding a level of distortion when you tax savings that you don't need. And a consumption tax gets rid of that extra level of distortion. You can think of it as apples versus oranges.
Isn't it the mainstream economists, almost everybody believes that with progressivity, taxing consumption is better than taxing income and savings?
Yeah, I think that's right. I think there's a broad consensus on that.
It's just a matter that we cannot go from where we are now to a progressive consumption tax with a political structure.
Yeah, and you know, interestingly, this isn't necessarily a Democrat-Republican split. It's that people are very conservative, and it seems very odd, so it's hard to get there. Yeah.
I guess the French expression, the more things change, the more they stay the same, is applicable. I sat in this very room 37 years ago and listened to Thomas Heller talk about a consumption tax, and he advocated at that time the idea of a consumption tax supplemented by a wealth tax of some sort. And one of his strong points of great emphasis was that an income tax is a tax on becoming wealthy. It's not a tax on being wealthy, it's a tax on becoming wealthy. And so in itself is an anti-egalitarian kind of approach to it. But my question, given all of that, is the constitutional limitation on direct taxes that we were talking about at the beginning, is that really a serious limitation on major restructuring of the tax?
Well,
if we could really do all these things, wouldn't we be able to?
Well, it depends on what you think of the Constitution, what you think judges really do. We have one here, but I think it would be a real stretch. I mean, some people say that. Some people like Bruce Ackerman, who's kind of an interesting, a great legal scholar at Yale, says, "Oh, come on. If we ever had the political will to do it, I think the Supreme Court could find a way to say that was constitutional." And people have come up with various arguments you could make. I think there's a problem of surface plausibility with those arguments. What do you think, Michael? Have you looked at that?
I haven't.
Okay. Yeah, I think it would be.
That's probably right.
What?
My guess is that if there were political will,
yeah. Now, for one thing, you're appointing Supreme Court justices at some point that are going to reflect that political will. Yeah.
Sorry, definitional fundamental question for one heavily involved in taxation other than payment. You said the estate tax is not an efficient tax. Can you elaborate on the meaning of efficiency in the sense of tax that just doesn't distort behavior?
Yeah, that's what I was thinking of. It's also a little bit tough to collect, but again, we've allowed the estate tax to be gutted, maybe unnecessarily, with escape hatches, which makes it even less efficient. So in theory, you got to value everything, and that's one of the problems of an estate tax. The big efficiency is people trying to get around it and stopping capital.
So implicit in that is that there's a definite understanding of what is the most efficient behavior that people
Yes.
would engage in.
Yes, that's right.
And you don't want to deviate from that.
Yeah, that's right. I mean, look, all of this is just at the margin. A lot of people are going to do anything no matter what you do, all right? So when we say that tax is going to discourage work or saving, we're not talking about the average person, we're talking about enough for there to be a cost.
Maybe one more quick question. Well, and seeing how
Wait, we got one at the back.
Okay.
If we did have the political will and could get rid of the prohibition, what do you think would happen? The constitutional prohibition on direct taxation.
Well, you mean if we had the political will to do it, to have a wealth tax, I guess the question kind of says, I guess we do it if we liked it. We had the political will. We have wealth taxes in states. They're called property taxes. They haven't done very well, in terms of political will, but they're a pretty efficient tax. So if you could imagine the political will to do it, it would be inequality by a large measure.
Just a side point, the political will.
Equality by a large measure.
Just a side point, the political will seems to be weighted heavily by the people who have the money and the wealth and might be taxed.
Maybe I don't know that, if you looked at Trump supporters, I don't know that they would support these tax systems. I don't know that they have the money. So it's kind of, I think the political ideology in this country is complicated.
Please join me in thanking